Okay, can everyone hear me? Awesome. Well, thank you guys so much for joining us today. We're really excited to have you guys. We've been doing these webinars for maybe a couple of months now, and I think each time they just keep on getting better and better. We have better topics. We are super grateful to actually a ton of you who recommended this topic, how to help your borrowers improve their credit scores, as something that you would be really interested in learning more about. So we're really excited to share this content with you today, especially because we think you're going to find it super valuable. So I'm not going to waste much time today. Mark Gordon, he's our National Director of Sales here at Princeton Mortgage. He's going to be walking us through this content today. Our goal is to make this as engaging and interactive for you as possible. So a couple of things. Number one, I will be promoting all of you from attendees to panelists on the Zoom webinar platform. This will allow you to turn on your video. So we'd love to see your face. We'd love for you to be able to unmute. If you have a question, feel free to ask it throughout the presentation. We will have a section for questions at the end, but if you have something that's relevant to the topic that we're talking about at that time, please go ahead, unmute, ask away. You can also utilize the chat functionality. Put your question in the chat. I'll make sure to be watching that and monitoring it, and we'll make sure to share those questions with Mark along the way. So again, thank you guys so much for being here today. I'm going to go ahead and pass it over to Mark, and we are going to get started with our webinar all about how your borrowers can increase their credit scores.
Awesome. Thank you for the great introduction, Courtney. And as she said, yeah, anything you guys can do to participate and make it more interesting for me. Certainly, I think the topic is awesome, but I don't always love just hearing myself talk for the full 45 minutes or so. So let me know. Make sure you just nod for me if you guys can see my screen. Are we good?
All good.
Awesome. Cool. All right. So today we're going to really focus on how the right loan officer and mortgage company. And by the way, if you look back at our other presentations, I don't really talk about how, you should use Princeton Mortgage or any specific loan officer, but I do think this is one area where not all companies are equal with this stuff. And so whether you work with Princeton regularly or not at all, I do think this is a really useful topic in terms of just understanding the difference and making sure that having a loan officer that's aware of these things and has experience doing this stuff can make a really big difference. So basically, we titled this Beating the System because here's the bottom line when it comes to credit scores. I'll go over our topics and I'll kind of just dive into what I was going to say. So we're going to talk about how mortgage underwriters review credit reports, how credit scores impact loan pricing and products, tips on consulting with a borrower with a low credit score, and what borrowers can do to increase credit scores quickly. The reason we call this Beating the System is because credit scores are simply the production of an algorithm from the 3 credit bureaus. And that algorithm is really looking at some things that may or may not be truly indicative of whether or not somebody has the ability to repay or is a good candidate for a loan. And oftentimes there are little things along the way that we can do that will greatly improve our credit score. And by the way, by having an improved credit score and getting better access to better pricing and products, it actually makes our borrowers better qualified and less likely to default. So when we talk about beating the system, it's not that we're cheating something or trying to get away with something. It's actually doing everything we can to make sure that we're putting people in the best loan they can possibly get qualified for. And so that's kind of what we're going to focus on here today. So how mortgage underwriters review a credit report, what's important to them. One thing I want to just kind of stipulate as we get into this, when I say a mortgage underwriter, oftentimes, while there is a person, a mortgage underwriter involved in every loan, a lot of things that we're going to talk about are actually done now by what we call an automated underwriting system, or AUS. And so definitely for loans that are going through Fannie Mae, Freddie Mac, FHA, VA, USDA, and less so maybe on jumbos or some other products, but on those core products, all these loans are being run through an automated underwriting system. And a lot of the things that we're going to talk about, what underwriters look for, is actually things that that the automated underwriting system is actually looking for. And that's another reason why we talk about beating the system, when it's a computer algorithm printing out a credit score and a computer algorithm evaluating that credit report. Having knowledge into how to set yourself up for success, and beating those algorithms in a way that's going to lead to better outcomes for you and your clients is really important. And so understanding how all that works, that's what we're going to kind of talk about today. So when mortgage borrowers and co-borrowers apply for a home loan, one of the first items an underwriter will look at is the tri-merge credit report on the borrower. So a lot of you guys probably know this. There are 3 credit bureaus: Equifax, Experian, and TransUnion. As a mortgage company, we are going to take the middle of those 3 scores. It's not an average of the 3 scores. So in other words, if you have one credit union that has you at 680 and one that has you at 580 and another one that has you, let's say, at 581, we're not going to average those 3. Your middle score is 581. That's the one that we're going to use for your credit score. This actually makes it, believe it or not, easier to beat the system, right? Because in a situation like the one here where it's 680, 580, and 610, I only have to get that Experian credit score up 10 points to go from a loan possibly not qualifying or qualifying for a bad loan and getting you into a 620 credit score where you qualify for something that was better for your client, or your client qualified for a better program. I don't have to worry about getting my TransUnion score up. I don't have to worry about getting the Equifax score up. Just that Experian score can do that. So it's another way just to kind of think about this in terms of how you can go ahead and try to beat that system. So that's really the summary of just the basics of how the credit scores themselves work, but it's not just score that can impact the mortgage underwriting process. So underwriters, or in this case, our automated underwriting system, is also going to look at the factors behind that score. So in other words, were timely payments made in the last 12 months? Are there any disputes on the credit report? Credit disputes, by the way, can actually make a score go up, but can still be looked at adversely by our automated underwriting system. So let me probably explain. I probably should explain this also. So even if you have a 680 credit score, for instance, if there are other risk factors for your loan, which is you have a high debt to income ratio. In other words, the amount of money you have coming in every month versus the amount of money we can see going out. If you've had bankruptcies or foreclosures in your past, mortgage rates in your past, if you have derogatory items like collections and things that are non-medical, our automated underwriting system can still turn your loan down even if you hit the minimum credit score to qualify. So these are the other things they're going to look at in addition to credit score to compound that. Now your pricing that you get, assuming you qualify, is all based on credit score and loan to value, right? But and the amount of the down payment you're putting down on a purchase. But whether or not you actually qualify is not exclusively credit score based. You can have a qualifying credit score and still not qualify if you're lacking in some of these other areas. So again, outstanding collections and charge-off accounts, credit trade lines. More trade lines is better. And again, thing to keep in mind here is that algorithm is trying to predict the person's responsibility with using credit. So if you don't have any credit trade lines, or you only have 1 or 2, it's harder to predict how you'll use those trade lines or how you'll use new trade lines when you get them. Conversely, if you have 30 trade lines and you've had them all for 30 years, we can very accurately see what you're likely to do with a new one. And so that's where so when we talk about predictability or credit score and also credit worthiness, the amount of accounts you have and the length of time you've had them adds to the predictability of your situation, which will improve your score and your mortgage underwrite. And guys, feel free to shout out questions or type them in if I'm going too fast. Overall payment history. So in other words, are you missing payments? And this will go back 10 years on the credit report to see if you've missed any payments on any of your accounts. One thing I always like to mention to people is your credit score is not impacted, or your credit report does not report any late you have that are less than 30 days. So you could be 28 days late on your credit card every single month and we would never know about it. It's only when you go over 30 days late that's going to get reported to the credit bureaus and impact your score. Same thing with any other type of trade line, mortgages, car payments, anything like that. And then how many different periods do you have of derogatory credit? So in other words, if one time somebody lost a job or had some other life-changing event and they went behind on us on a couple of things, that's looked at one way. If they've had several of those events over the last 10 years, it's going to be looked at as more likely to happen again. If a loan applicant has an overall 10-year credit history, the mortgage underwriter will look at the period of bad credit history and will want to question that. So a lot of times underwriters will ask for a letter of explanation on any of those things. So even if the automated underwriting system approves somebody, the person underwriter who actually goes through that will ask for explanations on some of those things. And occasionally the AUS itself, the automated underwriting system, will ask for those things. So how credit scores impact loan pricing and products. For you guys who came to the one that we did a few weeks ago, we spent the entire hour really talking about the impact of credit scores and what else impacts mortgage pricing. We went through that kind of with a fine-tooth comb. If you're super interested in this, I recommend you go back and watch that one, because I'm only going to kind of brush on it right here as it pertains to why we should be focused on getting credit scores up and how to work with your mortgage lender on it. But credit scores range from basically 850 down to, I've seen them as low as 400. Technically, they go down to 350. I don't think I've ever seen money lower than maybe 390s. Basically, anything at 850 is perfect, right? This is for mortgage credit, by the way. I have seen situations where, like, for certain credit, like for, if you go online and pull your free credit report, or you go to buy a car, their credit report systems work a little bit differently. And I have seen credit scores slightly above this, but on a mortgage credit report, nothing goes over 850. Anything over 760 is considered perfect by underwriting standards, or is excellent. 700 to 759 is still really good. You're going to be eligible for every type of program, but as you get under 740, it can start to impact your pricing. 640 to 699 is fair credit. We should be able to get you qualified, but you're not qualifying for the best programs, and there's certainly going to be hits to pricing. And then under 640, it can be dicey. There are companies that can get you qualified in certain situations. We do it down to 620 on many of our products, but you're certainly not qualifying for the best programs. And with many lenders, you're not going to qualify for anything at all. I would say probably about 80% of mortgage companies today will not do anything under 640. Part of that is that after the coronavirus stuff hit, they did raise their guidelines, but some of your big banks haven't been doing under 640 for a long time. So the credit scores impact, right? So credit score impact to pricing is multiplied by loan to value ratio. And so what I mean by that is that the credit score might predict your likelihood to default, but the loan to value predicts the likelihood of the lender to get their money back if they have to foreclose, or the percentage of their money back. So for instance, if you have bad credit, but you're putting 40% down, there's a very minimal impact to the pricing on your loan. If you have bad credit or fair credit, in that 640 to 699 range, but you're only putting 5%, 10%, or 20% down, the risk to the lender is large, and there's a very large impact to the pricing on the file, particularly if you're going with a conventional loan through Fannie Mae or Freddie Mac. FHA or VA, USDA, they're a little bit more lenient in those risk categories because of the mortgage insurance that's built in on those products. Private mortgage insurance, lenders require you to carry PMI if borrowers make a down payment that is less than 20% of the purchase price of the property. PMI insures the lender in the event of a borrower default. Private mortgage insurance rates are also impacted by credit. So again, that's why down payment and credit have such a tied-in relationship. If you have bad credit, but you can put 40% down, very little impact to the pricing and mortgage process. It's a non-risky loan for the lender, because if we had to foreclose, we would most likely get all of our money back. You're also less likely to walk away from it in that situation, because if you put 40% down, why would you get foreclosed on? You would just sell that house and do something else with the proceeds, right? So it makes you very unlikely to go into that bad situation. You would either sell the house or find another way. Conversely, if you're only putting 5% down, it may be impossible for you to sell that house in a pinch. And so that's where credit score becomes a very important part of the overall process. So I hope that makes sense to everybody about the inverse relationship. You can avoid, if you have bad credit but a lot of money to put down, less impact. If you have great credit but less money to put down, doesn't have a huge impact that you can only put a small amount down. The combination of those two things, and even if you're in the middle on both, it can get very expensive for your borrower. For your clients, I should say, for our borrower, for your clients. So tips on consulting a borrower with a low credit score. And we're going to lay this out for you. What can you do as a realtor, or even just if it's a friend of yours, to make sure that they're getting the best situation? So the first thing you want to do is you want to get this person to a mortgage lender as quickly as possible. There are many things a good loan officer can do with time to help somebody go from a really bad situation to a fair one, or from a fair situation to a good one, if we have time to go. So if we're getting introduced to a borrower and they're putting an offer in tonight and they want to close in 30 days, it pretty much is what it is. There's not a lot of room for us to fix or change anything at that point in order to make it a smoother or easier process, and it can cause a lot of stress. Conversely, if we talk to somebody who's thinking about starting to look, They put an offer in 30 or 45 days from now, and there's a 60-day period before they're going to close. That gives a good loan officer a ton of time to not only make for an easier mortgage process, but to set somebody up so they qualify for the absolute best program possible. So one of the first things I always tell people is give your loan officer time to work with somebody so that it can make a huge difference in the experience for your client. One of the things for credit scores below 620, a lot of what I'm about to go over with you guys applies to pre-coronavirus times and what I think will be happening again over the next couple of months. Right now, many lenders will not do anything under 620. There are a couple out there that I know are still doing it, but most won't. So if you're below 620, you cannot qualify for a conventional loan to Fannie Mae or Freddie Mac. That's not a lender specific thing. That is Fannie and Freddie do not do loans under 620. So your only options are FHA or in some cases VA for veterans, but you're going to go with an FHA loan. FHA loans, again, the risk to the lender is less because of the insurance money that people are paying up front in that insurance pool. And so you could, with 3.5% down on an FHA loan, you can go to a credit score of 580. Again, many lenders aren't doing this right now, but I certainly expect it to come back. And actually with 10% down, you can do a credit score as low as 500 through FHA, technically. So a lot of our down payment assistance programs work with FHA. And just to keep this in mind for your clients, as they start their home buying process, 20% of them have a credit score below 600. If we have time to work with that person and get their credit score over 620 or 640, they will qualify for a much more favorable loan, but probably, depending on the loan size, saving them $100 or hundreds of dollars a month right out of the gate. So getting that person, so when everyone says, you finally first start a buyer, why should I push them over to my loan officer right away? You want to give a good loan officer as much time as possible to get that client prepared for the mortgage process. It can literally be the difference in the amount of house that they can afford, right? $100 a month right now in terms of buying power is roughly $30,000 in purchase price, okay? So being able to get somebody into a loan here where they can save $100 a month in interest actually makes them able to, with the same monthly payment, qualify to buy a home that's $30,000 more expensive. Not only does that mean your client's happy because they get a better house, but you're also happy because you can earn more commission on that deal. So it can make a huge difference. How do we increase credit scores quickly? Why should we get this loan over to a loan officer? What's that loan officer going to go over with you? And this is kind of where the juice is for all of this. It's why everybody came here today. We have a process, and a lot of mortgage companies do this. A lot also don't. I'll explain why in a minute, called a rapid rescore process. So if you don't know how this normally works, each of the accounts you pay each month reports once a month to the credit bureaus. The credit bureaus take a couple of days to update that. And so even if you were to take a look at your freecreditreport.com credit report today, take all of their advice and make a bunch of changes, pay a bunch of debts down, do whatever you wanted, maybe 30 to 35 days from now, those changes will be impacted on the actual credit report that you pull. That's a long process. And by the way, if the results that you wanted, you don't get, you now have lost 35 days on that process. We can do a rapid rescore process where essentially you can do things with those accounts today, and in 3 to 5 days from now, we can have a new credit report issued with your new scores. So rapid rescoring is essentially what it sounds like, a rapid rescore. Lenders have access to a credit score simulator, which we'll talk about in a minute, and will kind of blow your mind if you saw it. That starts with the information on your current credit report and explores how changing that information can affect the score. These things are really cool. We can literally say, hey, our borrower has $2,000 to play with. What is the best thing they can do with that $2,000? Which account should they apply it to get their score up? And then what exactly will their score be when they do? And for the most part, it's very accurate. I have seen times where it was a little less than perfect, but it's certainly very close. And so really can make a huge difference for people. We can know exactly what the impact of making these certain moves will do. Borrowers can raise their credit scores quickly when they submit proof of the changes or the payments that they've made. And I've seen scores go up by more than 100 points in days, particularly if there's erroneous or negative information that we're clearing from a credit profile. I can tell you right now, I had a situation, I just refinanced my mortgage. Rates are at all-time lows. When I went and pulled my credit report through our company here, my score was way lower than I expected. Let's just say that. And I looked at it and I had a credit card. So I had my own company. I closed my company 3 years ago. the credit card company that I had suddenly and mysteriously in January charged me $100 annual fee, never sent me a bill, and they had marked me as 30 and 60 days late on that card. Capital One. Just, I don't mind throwing them under the bus. So I had to deal with Capital One, get that rectified, go through that process, order a rapid rescore, and have that reflected in my credit report in order to move forward with my refinance. If I hadn't had this rapid rescore system, I would have had to wait at least 35 to 40 days for that process to take hold. It took Capital One 2 weeks to investigate it. It was a whole thing. I'd wait on hold for a million hours. But once I got it actually done and corrected, I was able to do a rapid rescore to get my credit score right back up to where it was beforehand and where it started. So the rapid rescore process can work really well, especially if there's some sort of an error. In this case, it was 80-point difference between this 30 and 60 day late on this car that I had and not having that difference, which was the difference between, by the way, me, it was more than 0.5% in rate for me. So if I would have done the loan at that lower credit score without this rapid rescore process, or without knowing how to fix my situation, I would have been looking at a rate that was 0.5 point higher, or in this case, hundreds of dollars a month more expensive than getting my credit score corrected. This was my own personal experience that I just went through. So we just talked about this really. So the rapid rescore can get you a new credit report right away, can make changes, but really the coolest part of this is, and I'll give you a scenario here where I think that, you know, a really good loan officer can make a huge difference, okay? Let's say you have a borrower that was intending to put 10% down, and their credit score right now is a 639. And that 10% basically is all the money they have in the world. They've been saving up, but they want to put this 10% down. We can actually run a credit simulator and say, well, what if this person only put 5% down, but they took that other 5% and applied it to some of the accounts on their credit report? How much would their credit score go up? And would that difference in credit score result in an actual lower monthly payment for this person than just putting the extra 5% down would? Right? So putting 10% down instead of 5% down gets you you can have a better rate in that situation. You can have lower mortgage insurance. There's a bunch of advantages in terms of putting more money down. But in this case, if only putting 5% down frees up cash flow to repair the credit, that can sometimes have a bigger impact towards overall monthly payment than just putting more money down. And so if you give me time as a loan officer with that information to search these things out, and I'm a loan officer at a company who allows rapid rescores and can do this process, it can make a huge difference over the life of the loan for somebody. I'm talking about tens of thousands of dollars in interest they could save just by thinking. There's another way you can use this rapid rescore process where you say, hey, you may say to somebody, hey, this person qualifies. I can go to any mortgage company. Why would this make a difference? It's the creativity of knowing how they should be applying the funds they have in the best way to give them the biggest financial advantage over the long haul. So again, if you guys have any questions, type them out, shout them out, let me know. I know I'm moving quickly, but I think this is really cool stuff. So raise your credit score in days, not months. Talk about help boost the borrower's credit scores instead of taking months. We talk about how fast we can do this. Again, if there's errors, we can get them fixed right away. Obviously, you have to work with that company, but once we get proof of that error, here's how this works, by the way. So Capital One then writes me a letter and says, you are on time with your payments. We've removed the mortgage rates. Then we get that letter from Capital One. Great. I then take that letter and I submit it directly to the 3 credit bureaus. They instantly update my report and I pull a new report with my new score. It's that fast. And it's not like it just works like that for me. Anyone else then that goes and pulls my credit score, if I'm doing something else during the mortgage buying process, which hopefully I'm not, or house buying process, they're also going to see my new and improved credit score. So the amount of improvement in credit scores is based on the different things that can get corrected. So one of the things that I always talk about is a big portion of people's credit score is what we call revolving availability. So simply what that means is if you have a credit card with a $1,000 limit and a $900 balance, you're using 90% of what's available to you. And that's considered negative by the credit bureaus because in the event of an emergency, you have nothing to fall back on. So ideally, you want to be using less than 30% of you want your balance to be 30% or less of your available limits across your credit cards, okay? So in situations like that, knowing where to take your extra 5%, or maybe you only have $1,000 or $2,000 extra to play with to get your credit score up, knowing exactly which accounts to pay down and to what exactly to pay them down to to beat that algorithm is something our credit simulator can actually do. In fact, sometimes it'll come out with weird things like, hey, you have $2,000. You want to pay $508 to American Express, $1,100 to this Visa, and $100 to this collection you had. And that's going to be the best combination of things to get your credit score up 36 points. And it can be that specific in terms of what to do. So doing that process is basically the best way to get those results. So why don't all mortgage companies do this? Well, there are two reasons. The first reason, and the one they're going to tell you most, is, hey, we don't want to cheat the system. We don't want to have a situation where we're doing riskier loans for people that otherwise wouldn't qualify for them. And that's certainly the story that they tell their loan officers to tell people. And I think that's part of the reason. But we all know that just like studying for the SATs, if you have a tutor, no one considers that cheating, right? You just did the prep work to make sure that you got the better score. This is kind of the same thing here. It's not actually cheating. It's doing your homework, working with a professional to make sure that you're getting the best situation on test day possible, right? So the other reason is this. This process is expensive and time consuming. Most companies just don't want to spend the money. They don't want to do it. And it's actually illegal for the mortgage company to charge your borrower to do it. So for instance, in the scenario that I just gave you, where we had 3 different accounts that we wanted to do a rapid rescore with, each of those accounts probably is going to cost us $40 to update across each of the 3 credit bureaus. So in that case, I'm spending $360 on the rescores, probably another $50 on the scenario run that we're going to do. So that's a $410 process that's also time consuming for your loan officer to put through. And a lot of companies don't want to spend the money to do it, and they don't want their loan officer spending the time to do it. So one of the things you can always ask somebody, especially if you are working with clients that oftentimes fit into these categories, is, does your loan officer know how to do this stuff? Does their company allow for them to do this stuff? And then what is their experience level in doing it? Because there is, while it's very scientific once you get into it, there is an art to knowing how to apply the different amounts in different places in a way that makes sense, right? And knowing how I score by this much, but that affects my pricing by this much, and my mortgage insurance pricing by this much. What is the best way to work this system or beat the system so that my client is put in the best financial situation possible? And so this is, again, I will say this with a lot of confidence. I think most loan officers do not get into this for the most part, and most companies, including at Princeton. I think there's a lot of loan officers that just do not go the extra mile with this stuff. It's not something that occurs to them. It's not part of their natural wheelhouse or how they learn to do it. Maybe they're, quote unquote, old school, and this stuff wasn't available to them when they started selling loans, and now it's just not part of their normal thought process. But these are the tricks of the trade that can make huge differences to clients, both in the short term and the long term, in terms of what houses they can afford to buy, their comfortability of living in those houses as we move forward, and making sure they're in the best product possible for them, not just for the short term, but for the long haul. Questions about any of that stuff? Either I'm killing my explanations or I've already lost everybody. Nothing? Nobody? All right. Well, so rapid rescore steps. First step, get your clients to a licensed loan officer who knows how to do this. The best credit to begin with. Give that person and the loan officer as much time as possible to work with this person. There are things that we can do, by the way. There are things that are important in terms of how your bank statements look and money that comes in and out and the timing of those different transactions. That's really important. Gift funds, setting those things up, where to go from, how to get those things to. All of this, by the way, can be part of this rapid rescore process. Another thing is, so while you have to document a bunch of gift funds, right, for the mortgage loan process, you can certainly get gifts from your friends and family to fix the credit, which is not part of the normal mortgage process and falls outside of those things. So again, it takes a time to work that process and do those things. So again, a rushed closing. So let's say you've been working with a client for a while, all of a sudden they're ready to put an offer in, and that's the first time you're introducing them to a loan officer. You're putting your client at a disadvantage because there's no time to fix anything in that scenario in order to work that process over. By putting them in touch with a loan officer when they first start to think about buying, right? And sometimes that might be like, hey, I know you have 6 months left on your lease and you're thinking about buying when you get to the end of this. Before we start looking at houses or thinking about this, why don't you see what you qualify for and what you can do in the meantime to make sure you qualify for the best loan when you get there. Get that over to a licensed loan officer. Review that. And if it sounds, by the way, like I'm selling this because it works for me, I know it is in my advantage to have loan officers working on this stuff earlier, but it's just something I'm incredibly passionate about because I've just seen it cause so much pain to so many clients because they're like, I fell in love with this house. I didn't even know I was going to buy something. And they're like scrambling and running around, and the underwrite becomes more complicated, and we didn't set things up correctly, and maybe the loan gets turned down, or maybe it's just a nightmare of a process. Give your loan officers as much time as you can in these situations. It can make a big difference, especially if your borrower isn't perfectly qualified. Review the credit report with the mortgage loan originator and use the credit score simulator to determine how certain actions may impact your score. Again, important to let your loan originator know how much cash you have on hand or you have access to outside of your down payment and what you're expecting to use for the mortgage process itself, because that can make a big difference in terms of what we can rescore. For instance, when I run my simulator, if I say you only have $1,000 to play with, it can give me a bunch of options or may tell me there's no way for me to get your score up. But if I say I have $2,500, all of a sudden it may come up with 3 different ways I can get the score up to where we need it to go. So it's very important you let people know what you have access to when you begin this process. And then you can see here the different steps for determining why the credit scores are low, what we can do with the simulator to get things corrected. Here's my favorite part. And I want you guys to remember this too. If somebody has $0 to work on their credit score, there are oftentimes still many things that you can do to improve credit. I've seen instances where somebody was just an authorized user on somebody else's credit card. By removing them as an authorized user, I've seen people's credit scores go up by 60 points. I've also seen people have their credit score go up by 60 points by adding themselves as an authorized user to somebody else's positive credit card and credit account. I've seen things where just taking a loan out of dispute or putting something into dispute can make a huge difference in terms of credit score and how those things are being viewed. And so and a lot of times when people have collections, they paid them off. That original company that put the collection on the credit report is not the company that currently holds the collection when they make the payment. So it never gets updated to the credit report. Making sure those collections, if they've been paid, have been updated can also make a huge and significant difference towards credit score in the process. Or sometimes saying you paid them can actually make your score go down. And that might be something you want to avoid by checking with our credit simulator. So there's a lot of different things that we can avoid by going through this process.
Hey, Mark, we had a question come in from Vanessa.
Thank you, Vanessa. What's the question?
She asks, what's the best way for an individual to increase their credit score if they have lots of credit cards but almost no balances? Which cards should they close? I heard that the longer you've had the card, it matters.
Yes. So these are great questions. And so the first thing is, in general, there's really no reason to close accounts. More accounts and the average length those accounts have been open are both going to be positives for your credit score. If you were going to start closing accounts and you have really low balances and don't ever really intend to run those balances up as a percentage of the limits you have available, then if you really wanted to start closing some things for some reason, I would close the newest accounts you have. The average age of your accounts is going to make a huge difference. I can just tell you from doing analysis on my own credit report. So 2 things. One is, as a qualified individual for a mortgage company, I have different states and different investors taking a look at my credit all the time. So one of the things that always hurts my score is the amount of inquiries I've had. I've had 13 inquiries in the last 90 days, the last time I checked. I haven't bought anything other than just the new refinance that I just did. So that's something that's hurt my score. But the other only negative I have attached to my credit score is that the average length of my accounts is 5.9 years. And so the reason is because I've gotten a bunch of new accounts. I've started new things. I have my mortgage I just got. And so, and I've only had credit probably for the last 15 or so years. So the fact that my average length of an account is 5.9 years is actually considered a negative. You want that to be closer to the 10-year mark in order to get the best possible results from that. It's also why oftentimes, in terms of perfect credit, age can also be something that factors into it. It's not because there's age discrimination. It's because clearly if I have a 30-year track record of how you behave with certain things versus a 5-year one, I'm going to feel more comfortable being able to see 30 years than 5 years. And so you see that into it. So in terms of, I wouldn't necessarily go on my way to close any of them. I know that I use mint.com to keep track of my bills. It's a free service. I think it's awesome. They offer free credit reports, I think either monthly or every quarter. And it'll break down for you the different categories of what you can do to improve your credit. But in general, having more open credit to you is considered responsible by the credit bureaus, because what you're saying is, hey, I could go on a huge shopping spree and book a bunch of vacations and do all this stuff. I've had this stuff available to me for 10 years. I've never done it. I've been responsible. So I have a bunch of long accounts I've had for a while. My limits are high. I'm being responsible with that. I'm paying things down and keeping my availability high and my balances to limits low. And that's why there's a positive impact to your score. So inquiries are a small part of your overall credit score. You can still have excellent credit and have a bunch of inquiries, but your balances in relation to your limits is huge. And then here's the other thing. If let's say you have $100,000 in available credit to you and you're only using $2,000 of that, if you have a late payment on one of your cards, it really doesn't impact your score that much. And the reason is the credit bureaus go, that person probably just overlooked a bill, because why would they not pay that bill if they have $98,000 in credit available to them? It doesn't make sense, right? Like, you wouldn't just start missing bill payments all of a sudden. You would use those credit cards to make your bill payments, right? Before you would just miss a payment. So maybe you missed it, maybe it's an error. The credit bureaus are kind of forgiving while they figure that out. That's how the algorithm looks at it. Conversely, if you only have $5,000 in limits and you're using 4,800 of them and you miss a mortgage payment, it's like red flag, ding, 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 ding. And your score will drop 150, 200 points right away, because the credit bureaus, they don't know what's going on with your job. They don't know what's going on in the world right now. All they're trying to do is predict what's happening. And when you have nothing to fall back on, or no cushion, at least from a credit perspective, and then you miss a payment, that could be the first payment you're missing in a life-changing event, and there's no room for error. And so that makes you an incredibly risky borrower, which is what that score is trying to project. So another reason why you want to keep your balances low in relationship to your limits is because if there's an error, if you miss something or make a mistake somewhere, but the expense of that to your score can be far less. I hope that answers your question. And
I think it did for her. She said it makes sense. So we did have two other questions come in. One from Isabel said, if someone has student loans, would that limit how much you get qualified for, even if you have very good credit?
It can definitely, yeah, absolutely. And so two things that one is, if you're already in the repayment phase on your student loans, then yes, just like if those were car payments or any other bills that you had, those will be factored into your debt to income ratio. Where it gets really complicated and nuanced, particularly by program and product and investor, and there's other factors that go into it, is if your student loan payments are in the deferment stage, okay, how do we factor in what those monthly payments are going to be? And this gets really complicated because in general, what we're looking for as a mortgage company is 3 years of predictability with things. And so you might say to me, hey, I just started my PhD or my medical program. I'm going to have these student loans deferred for the next 4 years. Well, that would be great if I could document that, but the answer is I can't, because you could drop out of medical school tomorrow and those payments could be due right away. And so we have to then predict or estimate what those payments are going to be when you start making those payments. And so some investors will allow us to actually go to those student loan companies and ask them what the payments are going to be. That's also tricky because those payments are going to be determined upon when you actually start making them, because you're accumulating interest over that time period. Or we have to use a certain percentage of your loan balance and assume that that's going to be what your monthly payments are. But usually that's higher than what the payments are going to be. And so that can be punitive in terms of what you qualify for. The other thing I always like to say though about this is this, and this may be outside the scope of what I would normally say, but just as an actual recommendation, I'll just say it this way. If you have a normal income situation, like a W-2 job, and that is all the income that you get, right? If you can't get qualified for something, it probably means you shouldn't buy it. So there are tons of times where you have other sources of income. Maybe there's somebody, you have a girlfriend or a boyfriend who's paying rent, or you have a side job that you can't use for qualification purposes. And then it's fine to kind of stretch yourself out because there's a bigger situation. But in a straightforward situation, I'll give you some quick math on this just so that you can put it in perspective. If somebody makes $70,000 a year, $72,000 a year, so we use round numbers, they make $6,000 a month. After they pay their taxes, they're bringing home $4,500. For a mortgage situation, just on the mortgage, the taxes and the insurance and the other bills in the credit report, we will allow their total bills for the month to go to $3,000, right? So basically, it's 50% of the DTI, $6,000 a month, $3,000 in expenses. But those are just the expenses that we can see. Here are all the expenses that are not included in that are going to eat up that other $1,500. Food, gas for your car, cell phone bill, electric bill, water bill, gas bill, cable or internet, what you have. None of those bills are on your credit report. So they are not factored into your debt to income ratio. So when you say, okay, if someone makes $72,000 a year and the total payments on their credit report, the ones we can see are including the mortgage, are $3,000, there's very little room on another $1,500 to make things work. So another thing I always say to people is, hey, when your student loans do come out of deferment, are you going to be able to make those payments? Not just do you qualify, but like, what is your life going to look like? And I'm consistently surprised. I shouldn't say I used to be surprised, and now I just really want to help people because no one else is helping anybody talk through this stuff, right? It's, can I buy this house? Yes. Then is it a good idea is a whole separate conversation. And so you want to be able to be the trusted advisor in those situations as well, which is like, let's budget this out. What does this look like? So I know that was a long-winded answer to your student loan question, but it brought up something that, I'm passionate about because I've been able to help some people make some really good decisions with that recently. Just friends of mine that I think, you want to help people think through. Courtney, what else? What was the next question?
We had another one from Lee. What if someone is asking if they should open a credit card to improve their score? Does that help them?
So it depends on how much time we have, right? And so I would say that, like, if you're trying to buy a house in 60 days, I don't know that opening a new credit card is going to be a good way to get your credit score up. Let me think about it this way logically, right? If I'm evaluating your ability to pay me money and I find out that you just opened something new that gave you a new ability to borrow money, and I don't know what you're going to do with that or why you applied for it, that probably makes you more risky, not less risky. Now there is a piece of it where I go, well, maybe you're less risky because now you have this credit available to you in the event of an emergency. So I think that factors into it as well. But I also don't know what you're going to do with this or why you decided to apply for it. So in general, I would say that opening any sort of new accounts during the mortgage process, probably not the best idea. What I will say is, if you can, one thing again, this is kind of like a tricky situation or a tricky thing to even say as a tip. So I apologize in advance if this is kind of somewhat over the line, but I'll say, like, one thing I've seen really help people, especially first-time home buyers, is like they'll have a situation where they have some credit, but maybe their score isn't quite where they need to be, or they don't have a ton of established credit. And you say, well, what about your parents? Do your parents have good credit? Oh yeah, they're amazing. They have a ton of really great credit. If their parent has a 30-year-old Discover card with a $30,000 limit and they use it here and there for gas and they pay it off every month, just adding their child to that account as an authorized user, they all of a sudden get all of that positive stuff into their algorithm on their credit report, and it can change the entire equation. So if you can suddenly give somebody established credit on their credit report, that definitely will help their credit score, if that makes sense.
Cool. Two other questions. What was the company that you check your credit score on for free each month?
Mint.com.
I use it as well, and I love it too. It's
awesome. I mean, so you can attach all of your accounts to your Mint.com account. It will budget for you. It'll tell you if anybody ever charges you a late fee or any sort of secret fees. It'll tell you what your subscriptions are each month. It'll tell you things that you're overpaying for. For instance, if it sees that you're paying X amount for cable and it's like there's a promotion for cable in your area, they'll recommend that to you. So completely free tool. Obviously, they're taking all of your data and making tons of money off of it, and that's what they get out of it. But in the meantime, it's a free way for you to budget and see where all your money's going each month. And sometimes that can be a little bit sickening if you spend money like the way I do, but it's certainly a helpful tool.
Yeah. A couple more have come in too. I have a client whose identity was stolen about 10 years ago. It's still in her report. Her lender told her there's nothing to do but start all over. Is that true?
So my carefulness in this answer is that the full backstory of having your identity stolen is a part of this process. First, it's a nightmare. I can tell you that somebody that Courtney and I both know very well recently had this happen to them. It's been like months and months and months of awfulness, and this is a person who has the resources to like go after to pursue this in the right way, right? And so, as much as nightmares is for them, if you don't have those resources or you're relying on those credit cards or those things to survive and get by, I can't imagine the nightmare that it could create. So it really would depend on just the individual situation of what happened. 10 years out, it's hard to go back and relitigate some of that stuff. And so when somebody does have these issues up front, it's something you want to attack right away. You want to make sure you're filing the police reports and taking all the different steps you can to remove that stuff with the credit accounts at the time. But if you have proof that those accounts were not yours, you can do rapid rescores to get those things removed. So the short answer is it greatly depends on the individual situation. But if you want to reach out to me or shoot me an email, I'd be happy to talk to that individual person and see what we can do for them. It's just, I don't want to each situation is different when it comes to this specific issue. But I'm sorry for your friend. That's awful. And it happens, unfortunately, more than I think any of us realize until it happens to us.
Yeah, it's scary. Another question came in from Carl. It says, I have one trade line on credit and someone I know mentioned adding alternative trade lines to build my credit. What are these and are they worth adding to my credit report?
In terms of the actual term alternative trade lines, I don't know if that's something, either it's a term I'm not familiar with, or I think it would just mean getting new stuff and borrowing money. Again, all of the credit bureau score is about showing that over time you have repeatedly had access to credit or borrowed money and been responsible with it. So whether that was a car loan that you made, or student loans where you made on-time payments to, a mortgage that you made on-time payments to, or credit cards that you used in a responsible way and paid down each month, that's what's going to end up building your credit score. So anything that you can do that shows those things is the patterns you're looking to show over time.
And he also said, I think for the alternative trade lines like cable bills, utility, cell phone.
I'm not aware of how those things would impact your credit score directly. They could be uninformed on that, but that's not something that I'm aware of.
Cool. Those are all of our questions so far. Thanks, guys. These have been great.
No, absolutely. And so, I mean, I'm pretty much done with the information that I had here to share. I'll stop it there. But any other questions that anybody else has, or any other things that anybody wants to talk through, individual situations, please just shout them out. I'd love to answer those things for you. I'll hang out here for a little bit, but if you're leaving, thank you so much for coming.
Mark, I'm sorry. Can you hear me? Can you hear me?
Can. Yes.
Okay,
Hi, Nikki.
it's Nikki, and I've been in a car, so I have been listening, and I have not been able to ask questions. So I'm sure you missed all that extra time without me. But I wanted to address alternative credit for a second. Alternative credit is used when a borrower does not have enough lines of credit, and you have to show 3 lines of credit, quite often with an FHA loan. So you ask them for a copy of a bill, a utility bill, a cable bill, an electric bill. You use those things to alternatively prove to an underwriter that they are credit worthy. It does not, in fact, affect a credit score. It is affecting a credit profile. So the person who was mentioning alternative credit was doing a great job bringing it up.
No, that's a great point. So it's funny that I did not connect that with the question. Yes, so specifically around your credit score and your report does not impact. It can be the difference if you don't have enough trade lines specifically around being able to qualify for a mortgage. Thank you. That was a really great explanation. I appreciate it. Arthur, what's going on?
Doing well, thank you. This is fascinating. This is fabulous. I have clients who are elderly widows whose husbands did all the work, continually working for many years, so have income coming in on a regular basis, but not really credit savvy. don't have a credit card, have always paid always been responsible with their bills, but don't have the trade lines, at least conventionally. What would be their best recourse to sort of establish credit if they really want to try to get a mortgage as soon as realistically possible? I've heard some products of banks who may have accounts that you can open. Is that a desirable way? Or
Yeah, if you have time, establishing a credit card, even with a small limit that you use even for 1 tank of gas every month and then pay off, is a great way to start building credit. And again, I think one of the things you want to understand with this is that if someone really has no credit going into this, right, but they have the money coming in a steady situation, it's not hard, it does not take long to build a credit profile that will allow you to qualify for a mortgage, even if it's not the best mortgage. Mm-hmm. Your kind of like default starting point for credit is going to be in the 600s when you start opening up accounts and getting this stuff going. So assuming they apply for a couple of small credit cards, and some banks do have a thing where like if they have your money in a checking account, they'll give you the credit card attached to that, or you can even put like a deposit down for the credit card if you have bad credit going into it. So there are ways to establish credit that way. Again, people laugh about it, but like no matter how bad your credit is, there's 100 companies that'll lend you money to buy a car or some other things, and those things can absolutely start to help you to build your credit as well. So as Nikki said, 3 trade lines is kind of the magic number that we're looking for in the mortgage industry that people have going. And it's not, if you're starting from literally zero, it's pretty easy to get your score into the 600s where you'd be able to get a mortgage. If you're starting from an already derogatory place, it can be harder and take longer. But again, that's the other thing I want to mention with this is every situation is really different, which is why you want to get your potential buyer to a loan officer who can take a look at this stuff on an individual basis as early in this thought process as possible. And they can help you very specifically for that individual person's overall situation. Again, for that person, the amount of money they have coming in or going out, or the amount, kind of house they want to buy, all of that can factor into the equation so that they can get the absolute best advice for them.
Thank you.
Mark, we've had 3 other questions that have come in, so let's get through these. So first one, should you pay your monthly balance down to 0 each month on a credit card, or should you have a little balance remaining?
It's a great question. So here's what I always tell people. Technically, you would say, no, you shouldn't always pay it down to 0. You want to show that you're using that credit, not just, so in theory, if you paid it down to 0 on the exact day that your credit card reported it to the credit bureaus every single month, the credit bureaus might not know you were using that card. And so, which is not even really true anymore because now they actually track the amount you pay each month also. Let's just assume for a second it always stayed at 0. That's not really showing that you use credit responsibly. Having said that, very unlikely that if you're using your credit card throughout the month for small purchases, gas here or there, let's say you're spending $300 or $400 a month on your credit card and paying it off in its entirety every month, very unlikely that the day they're reporting it is going to be the day that you made that monthly payment. So there's always going to be some balance each month and it's changing. What's really going to help your credit score the most is that, again, your limits are much higher than your balances, right? So when you have a credit card that wants to offer you or extend you a higher limit, take it. Don't use it, but take it. It's going to positively impact your score. And then you want to see the balances moving up and down every month. And so what using credit responsibly looks like is, especially in a revolving way, is that some months you use it more, some months you get more money and you use less of it, you pay it down, and you want to see the balances moving up or down. It's when the balances are consistently moving up, and then we see a missed payment where it starts to really hurt people's scores in that sort of a way. So that's a great question.
Cool.
What else?
Another one, my listing got an offer with a FHA pre-approval, but seller wanted a second lender to pre-approve. And this time, do you recommend that? I was not familiar at all with this direct lender they used.
So, I think this comes down to like, if you can make it happen, of course, right? So like, all of this process with buying and selling is a negotiation, right? And it's about the leverage that you have. As a realtor, if you feel like we're in a seller's market where you're getting multiple offers, certainly to say to somebody, hey, we will go with your offer as long as our mortgage person also backs up that you qualify and you get the second opinion. You can, even if you say you can still use your guy, but my guy needs to see your stuff and get a chance at it. I think that's an awesome thing to be able to do. If you're in a buyer's market and you're just really hopeful and thankful that you got an offer at all, you might not feel comfortable having that conversation. I think both things are fair. I would say that anytime you can get yourself the insurance of having a second set of eyes that you trust on somebody's mortgage stuff, I think you should. We all know, first of all, we know that even if you have the best person in the world looking at it, there's always something that can happen during the mortgage process that's unforeseen that can derail things. For instance, like what we've seen here with the coronavirus, right? But certainly, even a good loan officer can make a mistake or overpromise and underdeliver or fail to have a difficult conversation with their client, where having somebody who's specifically looking out for your interest as the seller's realtor in this particular situation may come at it with a different opinion, or in terms of it, or at least let you know what things might happen or problems they could see arising during the mortgage process. So if you can get that other information, and that, by the way, that person who's applying with that other mortgage company, you tells that mortgage lender they're comfortable with you sharing that information with the realtor, then that's something that would obviously make you feel good. But so if you can pull it off, I would say, yeah, go for it. Plus, you may find out, your mortgage lender may be more loyal to you and continue to refer you business the other way in that situation. I know that as a mortgage lender, as a loan officer, I would certainly appreciate that type of an opportunity. And if you can then, that if your loan officer is able to give a better loan product to the other person, now it's something that you can see, you have, really control over that process in a different kind of way. And the deals look more likely to go even more smoothly. So I think there's a bunch of advantages to that.
Cool. Two more. If someone has an account in collections reaching the 7-year mark, should they pay that account off first or use the funds to pay down more current balances?
So again, I think it's probably a situation where I would run a rapid rescore and just see what, especially if I was going to be buying a house soon, right? I would probably run a rapid rescore to see what that was going to do to my credit. I believe, and some of this stuff changes from time to time, and I could be wrong about this, so I'll preface this, I don't know this for certain, but I believe that new event of you paying off that collection can keep it on your credit score. Like that can start the clock over again, right? Because it's not that account now is having a new action on it. So it's, the accounts that fall off after the 7 years or the 10 years, those are dormant accounts that there's no longer activity on. By paying that off, I think you can restart that clock. So I think if you're under the impression that collection is just going to go away, and again, that's only the case if that collection company isn't continuously reporting that you owe that money. So if it was a one-time collection placed on your credit report and it hasn't been updated in 7 or 10 years, yes, it can fall off. If every month that collection from 7 or 10 years ago is being updated by that credit company, it doesn't fall off the same way. So I just want to be clear about how that works. But so if it's being reported each month, then yes, pay it off and it should have a positive impact on your score, and you can certainly run the simulator. But if it's actually just going to fall off and go away because no one's reported it in the last 7 or 10 years, then I would leave it alone, probably. But again, feel free to run a simulator or Google search that, because that's just based on my personal experience.
Can Credit Karma help or hurt? It never seems to agree with the score the loan officer gives me.
Right, and so it's never going to, by the way, too, and that's kind of what I touched on a little bit earlier. The credit report system, and again, there's not a lot of information on this, by the way, and so our mortgage credit scores are always going to be a little bit lower than, and we're starting from a lower start point than what you're going to get when you go to the car dealership or Credit Karma or even on like a mint.com most of the time. Those are not mortgage credit reports. And again, I know that my mom has excellent credit. I know I went to a car dealership with her 10 years ago and she had a credit score of 869. And I was like, that's impossible. They only go up to 850. And the car dealership guy was like, no, I've seen them over 850 before. And I realized it's just a different system that starts with a higher possibility point. It's not very far off, right? Like I think when I pulled my mom's actual credit score, their mortgage was like in the 830s, which is still one of the highest scores I've seen. But there is an 850 cap on that. So we're working with a different system. I don't think using Credit Karma, by the way, is ever going to hurt your score, especially if you're using your once a year free credit report that you have access to. And I think more information with that stuff is always better.
Cool.
But again, if you do that, if you are thinking about buying a house and you're worried about your credit, you can always go to a loan officer to have them take a look at it as well. And they may not provide you the full report, but they can certainly share with you any information that's on it.
Great. Well, I think that was the end of our questions. The others were just panelists saying thank you and that it was tons of great information. So,
Hey guys, thank you so much for coming. And if you have any other, Arthur, actually 1 second, but if you have any other questions or you know any other realtors who would benefit from this, please share it. This is something that we'll do as long as we keep getting people to show up. So thank you guys all for coming. I really appreciate it. And if you guys have any topics that you want on this, you can always email me or call me directly, or when we send our surveys out, respond and let us know what those topics are. We want to give the people what they want. So I appreciate that. Arthur, what was your question?
2 questions. One, you had mentioned that if you have collections, non-medical, does that mean that medical collections do not show up in your record or are not an issue?
They do show up. They can affect your score, but they are looked at and viewed differently, particularly from a mortgage perspective. We are much more, the industry and even our automated underwriting systems are much more forgiving of medical collections than we are other sorts of collections.
Second question, if you do credit transfers, you're with the credit company for many years, they offer, transfer your entire balance to this account for an 18 months, 0, percentage interest. Does that help, hurt, indifferent?
It's a great question. So it does both, right? So it hurts you in that you're opening a new account, right? So now our average age of our accounts goes down. If that's something that, if in general you have a bunch of much older accounts, that might not hurt you that badly. But if you know that's already an issue for you, like it is for me, I certainly wouldn't want to open a new account just to do that. But transferring my balance on an existing account in that case would be fine.
That's what it would be, the same credit card.
Well, but here's normally if it's like on a balance transfer for a new card that you're applying for, then if it's an existing card, then really it's 6 of one or half dozen of another. What the credit bureaus are looking at is they're saying, okay, your total limit across your 6 credit cards is 100 grand. You're using 15 grand, that's 15%. And that's kind of the way they're looking about that. So whether that 15% moves from here or here, it's not going to really have much of an impact on your score. So now, if you can call any of those existing credit card companies to get them to raise your limit, and at the times you need them to raise your limit, they won't, right? So at the time where you're like, man, I've used 80% of my available credit even to raise my limit, they're probably going to say no. If it's at the times you don't need it that they're going to say yes. So don't be afraid to ask, right? When your credit's in the best standing possible, let's say you're buying a new house, you're going to spend some money on credit cards to get new furniture or this or that. In those moments, you can always ask for your limits to get increased, and that will help your score or lessen the impact of using that credit down the road, because again, as a percentage, you'll be using less of what's available to you.
Thank you.
Great questions. Anything else?
It was.
All right, guys, thank you so much. You have no idea how much I appreciate you taking the time and your lunch with us. Hopefully someday we can do it in person and actually buy everybody lunch, but stay safe out there, and we look forward to doing this again in 2 weeks.
thanks, everyone.
Thank you, Courtney.